Welcome everyone. My name is Bushra Koster and I'm a student of PIA, and we are gathered here to make an video presentation of ACC 501 Accounting System and Process. So let's start without wasting the time. Um, the first section is Statement of Cash Flows for the year ended June 30, 2021. So first point is cash flows from operating activities, which is the section of the statement of cash flows. Um, Reports that amount of cash that the company has generated from its core business operations. In this case, Limited Company has generated a net amount of 47,700. This indicates that the company's day-to-day business operations, such as selling goods or service to customer and paying suppliers, and employees were able to generate a positive cash flow. If we come to the next point, which is cash flows from investing activities, this section records the cash used for investing in long-term assets and the proceeds from the sale of these assets. The company has purchased machinery and land amounting to $93,000 and $39,100 respectively, and has sold some machinery and land generating 33,000 and 35,800 respectively. So now the third point is cash flows from the financial activity. This section reports cash changes resulting from activities such as issuing shares, paying dividends, borrowing money, and repaying loans. In this case, Lot Limited company has generated a net inflow of 24,600 from financial activities. Uh, The company issued share amounting to 70,000, borrowed 28,000, paid out dividends of 61,400, and paid interest of $12,000, which indicates that the company has raised more funds from shareholders and creditors than it has returned to them. Now, next point is net increase in cash and cash equivalents. The company cash and cash equivalents have increased by 16,500 over the period. This is a positive sign as it indicates that the company has been able to generate more cash than it has spent over the year. Next, the last point is that cash equivalents at the beginning and end of the period, the company started the year with 6,500 in cash and the equivalent and ended the year with $23,000. The increase in cash and cash equivalent suggests that the company is in a better liquidity position at the end of the year compared to the beginning of the year. So, in the conclusion, despite significant investments in long-term assets and dividend payments, Lord Limited Company was able to increase its cash balance during the year due to positive cash flows from operating activities and successful capital raising efforts. This is generally a positive sign for the company's financial health. However, for a more complete understanding of the company's performance, this flows components should be analyzed in the conjunction with other financial statements like the income statement and the balance sheet. Now, if we come to the cash generated from used in operation, this section presents a reconciliation of the company's net income profit of the year to its cash generated from the operative activities, often referred to as the indirect method for calculating cash flows from the operations. The net income in the starting point amounting to 33,000 adjustment are then made for non-cash charges and other items. These adjustments convert the income statement from accrual basis to a cash basis, which is the purpose of the cash flow statement. Here, the adjustment made. Depreciation. Depreciation has an expense report on the income statement that doesn't involve an outflow of cash. It is added back to net income because it reduces profit but not cash. Lease income received, this is the second point. It appears that this income is not from operation and therefore it's subtract from net income. The third point is loss on disposal of land B, a non-cash expense that is back to net income because it reduced profit but not cash. The fourth is gain on sale of machinery, a non-operation gain that is subtracted from net income. And the last is interest expense. Typically, this will be a non-cash expense if the interest has been accrued but not yet paid. The result after this adjustment is then further adjusted for changes in working capital. Changes in working capital represent the net changes in the current assets and liabilities. So now current assets is an increase in the current assets account, inventory, prepaid expense. Account receivable is considered a use of cash and therefore it is subtracted. A decrease will have been an addition. The next is current liabilities. An increase in the current liability account payable, other accrued expenses is considered as sources of cash and therefore it is added. A decrease will have been a subtraction. So the net cash flows from operating activities or cash generated from operations is 47,700 after this adjustment. This positive cash flow indicates that the company primary business activities have generated more cash than they have used over the year, which is a positive indicator of the company's ability to cover its operational expenses and invest in its future growth. So now, if we go to the slide 4, it is an section 2 introduction of the recognition and measurement of intangible assets have been a prominent subject of debate among accounting professionals worldwide. But 2003, this has been highlighted the task complexity, the transition from IFRS 8 by International Accounting Standard Board to Australia, AASBI 138 demonstrated this complexity. This adds a new layer of the challenges to the accounting landscape. This essay includes the exploration of the complexity associated with recognizing intangible assets under these standards. Some present examples are presented to illustrate these complexities. The first section of this essay includes the discussion about intangible assets under IFR 38, AASB 138. After that, we analyze complexities in recognizing intangible assets. So now, my turn is ended here. So I'm gonna give a chance to the other group member. So thank you for watching it. Thank you.
So next slide, please. Yep. So can you open the slide? Yep. So hi, my name is Mohammed Salman. So in this slide, this shows a graphical representation of different measurements, how to the methods for intangible assets. So next slide, please. So in this, intangible assets are unique in their nature. So it is because they represent non-monetary assets that lack physical substance. Though these are, however, crucial to the economic success of many businesses, these assets can include everything from patents and copyrights to softwares or trademarks, relationship with customers, and recognition of the brand. IFRS is an internationally recognized and AASB 138, it is an Australian equivalent. This provides a comprehensive set of rules to talk about the way in which to handle these assets in financial reporting in any organization. So the standard stipulates that an intangible asset should be recognized just in case if it is probable that the expected future economic benefits that are attributable to the assets will flow from the entity and the cost of the assets can be measured reliably. This standard creates a consistent framework under IFRS and AASB 138. This framework makes sure that the companies across countries and sectors can reliably and fairly report their intangible assets. Next slide, please. So in this one, there are some types of intangible assets and their asset lists. So it has 6 types of assets types. So one is goodwill, One is brand equity, another is intellectual property, licensing and rights, customer list, and research and development. So now going to the next slide. So, however, the application of these principles can become a complex task. So, this could be faced particularly considering the diversity and uniqueness of the intangible assets. For example, the probability of future economic benefits flowing from an intangible assets often requires professional judgment. It could be resulting in a different interpretations and conclusions. Likewise, measuring the cost of an intangible assets can be tricky, especially for those that have been generated internally. The cost of an asset might be encompassing different elements. This includes costs being incurred in development and maintenance of improvement of the assets. So according to MIA, IFRS 38 and AASB 138 also provide rules on how to determine the useful life of intangible assets and the appropriate method of amortizations. Thus far, this task can also be complex due to the specific nature of intangible assets. The useful life of an intangible asset might not be straightforward to determine. This case is particularly for those assets that are strong linked to technological change. The method of amortization might also not reflect the pattern in which the economic benefits of the assets are consumed. So now Sachin is going to continue from here on. So can you just go on to the next slide, please?
My name is Sachin Kumar. I will discuss the few slides. The first slide is complexity in recognition intangible assets. The recognition of intangible asset involves several complexity. It is a process that requires carefully judgment and expertise because of the unique nature of these assets. Here are some of the main complexity. The first is the identification and separation. In this, intangible assets can be challenges to identify and separate from other assets. Separate those assets from goodwill and separate from all other assets of recognition and measurement purpose because of complex task. This is because these assets lack of physical substance. And for example, how can we accurate the separate the value of brand reputation for customer loyalty or other customer relationship assist. Next is uncertain for further economic beneficial. IFRS 38 AASB 138 specifies that an intangible assets must only be recognized if a probability that further economic benefit will flow to the economy, though prediction of those future beneficial is often uncertain. According to Ho et al. 2023, this is especially is often intangible asset which may fluctuate greatly dependent on future market condition like brand recognition, customer loyalty, or probability technology. This uncertainty make it challenge it assist whether the recognition criteria are met. In the next slide, I will talk about control and ownership. Demonstrate control over an intangible asset could be another complex task, particularly in instance where legal right don't provide sufficient evidence of control. This evidence of control could be internal generate goodwill, intellectual property, or knowledge assist. This can be said as difficult to prove that an organization controls the future economic beneficial that may flow from asset. This requires understanding and judgment of both the asset itself and the context in which it operates. Measurement. Measuring the cost of intangible asset can be particularly challenging task. Measuring the cost of initially generate intangible asset is more complex while purchasing intangible assets are usually recognized at cost. It could be difficult to accurately allocate cost related to those assets. This difficulty could be faced particularly when they are made developed over a long period or by product of other activity. Furthermore, choosing the appropriate method of substantial measurement after initial recognition. In this next slide, I will discuss about the brand. In this slide, I will discuss the example of below highlights nonsense involves in recognition intangible asset. These also demonstrate the required carefully professional judgment grounded in a understanding of relative accounting. First is the brand recognition. A company like Apple has built a highly recognizable and trusted brand over the decades. This brand decades is undergone a significant contributor to its market success. Influence customers purchase, discuss and decisions and allow Apple to charge premium price. However, qualifying the value of brand recognition pose a considerable challenge. It compares various factors, including brand loyalty, premium price, and potential further revenue. In after me, and the next is the Manpreet, who tell you all about the slides.
The next slide is slide 11. These examples shown below highlight the intricate nuance involved in recognizing intangible assets. These also demonstrate how it requires carefully personal judgment grounded in a comprehensive understanding of the relevant accounting understands. Number one, brand recognition. A company like Apple has built a highly recognizable and trusted brand over decades. This brand recognition is a significant contributor to its market success, influencing customers' purchases decisions and allowing Apple to the charge premier prices. However, quantifying the value of brand recognition poses a considerable challenges. It encompasses various factors including brand loyalty, premier pricing, and potential future revenue. Further, as per IFRS 38 slash ASB 138, internally generated brand recognition is not recognized as an intangible asset on the balance sheet. It can only be recognized if acquired as part of a business combination, creating a inconsistency in financial reporting for different companies and adding to the complex. Slide 12, number second, software development. A technology company, let's say a gaming company, might in extensive software development. However, recognizing
Bushra,
this
next slide.
internally generated software as a intangible asset involves complex judgment. According to IFRS 38 slash AASB 138, the company must differentiate between research costs incurred in the research for new knowledge and development, the application of research finding to a plan of design for new substantially improved material devices, products, process of services before commercial product on use. Research costs as expensed and incurred while development costs can be once technological feasibility of demonstrated and it's probable that future economic benefits will flow to the company. Slide 13. Conclusion, recognition of intangible assets as per IFRS 38 slash AASB 138 is complex but crucial for the financial reporting. These assets like brand recognition, software development, customer relationship, and internal generator goodwill have become increasingly vital in today's business landscape. The tangible and often uncertain nature of these assets makes their recognition, measurement, and disclosure a complex task. Thank you.
Bushra, can you pause the recording, please?